Imagine growing your retail revenue by 35% in a single year.
Which is just a massive number.
Right. I mean, you hit over 25,000 crore rupees, and you do it in an industry that has essentially done the exact same thing for like 1,000
Oh,
years.
absolutely. I mean, usually a traditional jewelry business is, well, it's like a massive cargo ship weighed down by literal gold.
Yeah, it's incredibly capital heavy. The inventory moves at this glacial pace, and you basically have to lock billions of rupees in glass cases and just, wait for a customer to walk through the door.
Which makes it the absolute definition of a capital-intensive industry. It ties up cash like almost nothing else in the modern retail landscape.
But then you look at what is happening right now with one specific player in the organized retail space, and suddenly that sluggish cargo ship is, well, it's behaving like a speedboat.
It really is.
We are looking at a financial landscape today that is genuinely staggering. So, welcome to today's deep dive, customized specifically for you. Our mission today is to explore how one of India's most glittering retail giants, Kalyan Jewelers, managed to completely rewire the mechanics of a traditional brick and mortar business.
And they pull this off while simultaneously mitigating some immense, existential commodity risks.
Exactly. And we've got an incredible stack of sources to guide us through this. We are looking directly at the official quarterly financial results from their May 8th, 2026 Board of Directors meeting.
Right, which includes the audit conducted by Walker Chandiak and Co. LLP.
Yeah, plus we are pairing that with a deeply detailed ICRA ratings rationale document that was published back on April 10th, 2026.
And those two documents combined, they really give us a very clear, completely unfiltered look at their debt structure, their overarching strategy, and their operational health over the last few years.
Yeah.
Okay, let's unpack this. We are going to figure out how Kalyan Jewelers achieved a massive 32% compounded annual growth rate of operating income over 3 years.
Without drowning in debt.
Yes, without drowning in the kind of debt that usually sinks these aggressive retail expansions.
What's fascinating here is that this isn't just a story about selling gold necklaces. It's a masterclass in financial restructuring. It is about actively shifting market share and completely rethinking who actually holds the risk in a retail environment.
So let's start with the top line sparkle, because the baseline facts from that May 2026 board meeting are just wild.
They really are.
Before we talk about how they are growing, we need to look at what they've actually achieved. At that meeting, the board recommended a final dividend of 2.50 rupees per share.
Which is 25%.
Right, for the financial year ending March 31st, 2026.
Issuing a dividend like that is a massive signal of confidence to the market. A company doesn't just hand out cash to shareholders unless its internal cash generation is robust enough to support both daily operations and, future growth initiatives.
Yeah, and the auditors backed up that confidence too. Walker Chandiak and Co. LLP issued an unmodified audit report. And I want to pause on this for a second.
Sure.
Because historically, the jewelry sector in India has been, well, largely unorganized. It was mom and pop shops, a lot of cash transactions, and sometimes questionable inventory accounting.
Oh, definitely.
So an unmodified report from a major auditor means what exactly in this context?
It means their financials are entirely clean. There are no red flags, no weird accounting tricks, no hidden liabilities tucked away in the footnote somewhere.
Okay.
It is a solid bill of health, which is absolutely crucial for a company trying to attract institutional investors in a sector that used to be, frankly, notorious for its lack of transparency.
And ICRA clearly agrees because they reaffirmed a stellar ICRA AA- rating with a stable outlook for Kalyan's long-term fund-based working capital and fixed deposit programs.
Which is a huge deal.
Yeah, to put that in perspective for you listening, this rating covers a massive 3,850 crore rupee limit.
Right, and an AA- rating from ICRA translates to a very high degree of safety regarding the timely servicing of financial obligations. The credit risk is viewed as very low.
Wow.
I mean, when you're dealing with a working capital limit approaching 4,000 crores, the banks need to know you are good for it.
Which brings us to the revenue numbers, and this is where I had to read the document twice.
I bet.
Their consolidated operating income hit an impressive 25,034 crore rupees in the financial year 2025. That is a massive jump from 18,500 crore in FY20.
Yeah, with a profit after tax of 714 crore.
Right. But here is the hook. Just in the first 9 months of the financial year 2026, they saw 25,468 crore in revenue.
They literally eclipsed their entire previous 12 months of revenue in just 9 months.
But I have to push back a little here, though.
Okay, go ahead.
Gold prices have been incredibly buoyant globally. Are they just benefiting from the underlying asset becoming more expensive? Like, is this actual structural business growth or just commodity inflation disguised as
Yeah,
genius?
it's the first thing any skeptical analyst would ask.
Right.
But if we dig into the ICRA rationale, the numbers tell a different story.
Oh, really?
Yeah, while higher gold prices certainly inflate top-line revenue to an extent, the real engine is volume and physical footprint.
Mm.
They achieved a 20% same-store sales growth in FY25.
Meaning the existing stores, the ones that were already open, are just selling 20% more product.
Exactly. That is the metric that proves the existing network is humming. It's not just new store openings masking old, stagnant locations.
Got it.
But beyond that existing growth, their aggressive network expansion is what's truly driving the volume. They added 135 stores in FY25 alone and another 81 stores in just the first 9 months of FY26.
But this brings up a massive contradiction. Expanding a jewelry network usually requires buying tons of literal gold to put in the display cases of all those new stores.
Very true.
It is insanely capital intensive. If you open 135 stores, you need the inventory to fill them. So how on earth is Kalyan affording this massive scale-up without taking on crushing amounts of debt to buy all that gold?
That is the multi-billion rupee question, right? The answer lies in the absolute core of their current strategy.
Yeah.
It's a mechanism they introduced in the financial year 2023 called the FOCO model.
Oh, Chico.
Right, this stands for franchise-owned, company-operated.
Oh, I saw this in the notes. By December 2025, they had added 268 of these FOCO stores, compared to only 46 of their own FOCO stores, company-owned, company-operated.
And the financial transformation this caused is remarkable. Before FOCO, back in FY22, their inventory days stood at 221.
Wow.
That means, on average, a piece of jewelry sat in their system for 221 days before being sold. But by FY25, that metric dropped to 156 days.
That is over 2 whole months shaved off the time a piece of gold is just sitting in a vault tying up cash.
It directly impacted their net working capital to operating income ratio. It plummeted from 41% in FY22 down to 21% in FY25.
That's a huge drop.
They essentially halved the proportion of their income that was trapped in working capital. And because they aren't sinking their own cash into building every single store, their return on capital employed, or ROCE, soared from 8.9% in FY22 to 14.4% in FY25.
Let's use an analogy for this. They essentially pulled an Airbnb or an Uber, but for retail jewelry.
Yeah, that's a good way to look at it.
They are using other people's capital, like the franchisees' money, to hold the actual heavy gold inventory and build the physical stores.
Yeah.
But Kalyan is maintaining strict company control over the daily operations, the staff, the marketing, and the brand experience.
Exactly. If we connect this to the bigger picture, the franchisee takes on the heavy lifting of capital expenditure and the inventory holding costs. Kalyan takes on the management, the supply chain logistics, and the brand trust.
So the franchise buys the gold, but it sits in a store that says Kalyan over the door, run by Kalyan staff. But wait, let's look at the debt metrics for a second.
Okay.
The ICRA report notes that their total outside liabilities to tangible net worth, or TOL over TNW, stood at 2.1 times in FY25. Let's translate that. Tangible net worth is basically the actual physical value of what the company owns.
Right.
So if their liabilities are 2.1 times that, it means for every dollar of hard assets, they owe $2. Why is that considered healthy in retail?
Well, in a traditional heavy manufacturing business, you might worry about that ratio. But in a fast-turning retail model, especially an asset-light one, it's actually quite strong.
How so?
Remember, under the FSACO model, their tangible net worth doesn't need to be massive because they aren't owning the real estate or the bulk of the new inventory. The liabilities they do have are supported by incredibly fast-turning inventory and high cash flow generation.
There is no free lunch in corporate finance, though. By using the franchisee's capital, Kalyan has to share a portion of the profit margin with them.
They do. And as a result, their overall operating margin percentages have moderated slightly compared to a fully company-owned model.
Right.
But, they're gladly making that trade.
Makes sense.
You are giving up a few points of margin for a vastly superior return on your own capital and a dramatically lower working capital requirement.
You trade a slice of the pie, but you get to bake 100 times more pies without ever having to buy the ovens.
That's spot on.
So, with a highly scalable asset-light model in place, the next logical question is, where are they putting these 200 plus new stores, and what exactly are they pushing customers to buy?
Right, because if you are giving up a share of the profits to franchisees, you need to find ways to maximize the absolute value of what you are selling to offset that cost. You have to ruthlessly optimize your geography and your product mix.
The sources show a massive geographic pivot. Historically, South India is the undisputed gold buying capital of the country. It's cultural, it's deeply ingrained. But Kalyan is rapidly shifting its reliance away from the South. Their non-South market revenue share climbed from 34% in FY22 all the way to 54.4% in the first 9 months of FY26. They are expanding heavily into the North, the West, and the East.
And they are not stopping at the Indian borders either. They are actively building a global footprint. The West Asian markets currently contribute around 12 to 13% to their consolidated revenue. More recently, they have planted flags in the U.S. opening stores in New Jersey and Chicago in 2025. And they opened a showroom in the UK in December 2025.
Here's where it gets really interesting for you listening at home. It's not just where they're selling, it's what they're selling. South India traditionally loves heavy, pure gold jewelry.
Right.
But gold is practically a commodity. You often sell it almost at cost, making a tiny, transparent margin just on the making charges. But Kalyan's product mix is evolving. The share of studded jewelry, which means pieces with diamonds and precious stones, is consistently rising. It hit 31% in the first 9 months of FY26.
And this is the strategic counterweight to the FYCO model.
Because studded jewelry is where the real retail markup lives, right? A diamond doesn't have a daily spot price flashing on a screen that the customer can check on their phone.
Exactly.
The margin on a diamond necklace is vastly higher than a plain gold bangle. So pushing into the North and West, where studded jewelry is culturally more popular, must be a completely deliberate margin play.
You've hit the core of the strategy. This is exactly how they are offsetting the profit-sharing costs of the FOCO model. By selling higher-margin studded items in these new non-traditional geographies, they keep their absolute profitability very high, even while splitting the top-line revenue with their franchise partners.
They are also pushing a sub-brand called Candor Ray, right? The ICRA report mentions they added 68 Candor FOCO stores in India. We should dive into this because a traditional Kalyan store is massive heavy doors, security, huge wedding collections. Candor sounds different.
It is. Candor is their lightweight, affordable jewelry brand. This targets a completely different consumer psychology. Instead of a family planning for months to buy a heavy wedding set, Candor is targeting younger demographics, millennial and Gen Z consumers looking for daily wear or impulse buys.
That changes the cash flow cycle completely.
Radically.
Yeah.
A smaller footprint in a mall, selling lower ticket but higher margin diamond pendants, requires far less working capital to stock than a traditional flagship store. It diversifies their revenue stream away from just the wedding season and massive festivals, creating a more consistent, year-round cash flow.
Okay, I'm looking at this flawless blueprint. High margins, asset light, global expansion, diversified brands. It feels almost too perfect.
Sure.
If I'm an investor listening to this, I'm immediately looking for the trapdoor. The retail jewelry industry is notoriously vulnerable to external shocks. What takes this whole system down? How is Kalyan protecting this moat?
That is the crucial stress test for any business model.
Yeah.
For jewelers, the two biggest existential storms are always commodity price volatility and sudden government regulations.
Gold prices have been on a wild ride globally. If you hold billions of rupees in gold, a sudden drop in the global price could wipe out your balance sheet overnight.
Right, but Kalyan has essentially neutralized that risk entirely.
Yeah.
According to the ICRA rationale, the company hedges its entire gold inventory.
Let's explore the mechanics of that. How exactly does a massive jewelry network hedge its entire physical inventory?
They use financial instruments like gold metal loans. Think of it like renting a car instead of buying it.
Okay.
If the value of the car plummets the second you drive it off the lot, you don't care because you just hand the keys back at the end of the day.
So they are essentially renting the gold?
In essence, yes.
Hmm.
Instead of buying gold outright with their own cash and taking on the price risk, they borrow the physical gold from a bullion bank.
Interesting.
They manufacture the jewelry, sell it to the customer, take the cash, and then repay the bank the cash equivalent of that gold, plus a little interest. If the global price of gold crashes while it's in their display case, they owe the bank less cash.
They are entirely removing the speculation from the business. They aren't betting on the price of gold going up or down. They are just making their margin on the retail markup and the design value.
Yes, it provides incredible stability to their profit margins, regardless of what the global commodity markets are doing. The commodity price risk stays with the bank or the market, not with Kalyan.
So they've bulletproofed themselves against the commodity markets. But what about the government? The ICRA report mentions a specific regulatory event.
Right, in July 2024.
Yeah, in July 2024, there was a 9% customs duty cut on gold. The report says this caused a one-time loss that hit Kalyan's operating margins by about 50 basis points, which is half of 1% in FY25. Wait, let me challenge this.
Go for it.
A tax cut hurt them. I thought lower import duties would be a good thing for a jeweler. You can import gold cheaper.
Well, this raises an important question, right? Because it reveals the fascinating counterintuitive nature of the global jewelry market.
Okay.
In the immediate short term, a sudden drop in the customs duty meant the physical inventory they were already holding in their stores, which they imported and paid for at the older, higher tax rate,
Yeah.
suddenly dropped in market valuation.
They had already paid the high tax on the gold sitting in the back room, but now they had to sell it to consumers based on the new lower tax rate.
Exactly. That caused the brief, one-time accounting hit of 0.5% on their margin. But, and this is the crucial historical context, the ICRA report makes it clear that this duty cut actually helped Kalyan immensely in the long term.
Why?
We have to look at the unorganized versus organized market in India. Historically, India's immense love for gold, combined with high import duties, created a very lucrative black market.
Smuggling.
Yes. High import duties act as a massive incentive for illegal smuggling. Unorganized, shady jewelers smuggle gold in to avoid the tax, and because they avoided the tax, they can easily undercut the organized, compliant players on the retail price.
So by slashing the duty by 9%, the government effectively destroyed the profit margin of the smugglers.
Overnight, the risk of smuggling was no longer worth the reward. They disincentivized illegal imports entirely.
That levels the playing field completely.
Better than leveled it. It handed market share straight to the organized, compliant players like Kalyan. When the price gap between the unorganized shop on the corner and the trusted Kalyan showroom shrinks, the consumer naturally migrates to the trusted brand for purity guarantees and better designs.
Wow.
It accelerated the formalization of the entire jewelry sector.
A short-term accounting pain for a massive, long-term structural advantage. So what does this all mean for you, the listener? Let's bring this all together.
It's a lot to take in.
It is. This deep dive isn't just about a jewelry company selling necklaces. It's a blueprint for anyone interested in business strategy in any sector. It shows how transitioning to an asset-light model, the FOCO model we unpacked, completely changes the physics of your growth.
It frees up your capital.
Exactly. It shows how pivoting your product mix toward higher margins like studded jewelry and impulse buy brands like Kendere can offset the costs of scaling. And it shows how aggressively hedging your supply chain risks, whether it's through gold medal loans or capitalizing on regulatory shifts against smugglers, can turn a sluggish, capital-heavy enterprise into a fast-scaling cash machine.
And yet, if we project this blueprint into the future, it leaves us with a rather profound question to consider regarding the evolution of retail.
Oh, let's hear it.
If the FOCO model is truly this effective at removing the traditional capital bottlenecks of retail, if you no longer have to buy the heavy inventory or build the store yourself, then the future constraint for jewelry giants won't be consumer demand, and it won't be gold supply.
Then what is it?
The ultimate battleground will shift entirely. It will become a war to recruit the wealthiest, most reliable franchise partners.
That is fascinating. The bottleneck isn't the consumer, it's the partner.
Right. When every major brand inevitably pivots to asset-light franchising to keep up with this growth velocity, the dynamic changes. Does the brand with the best jewelry designs win the market? Or simply the brand with the most compelling B2B financial pitch to wealthy investors looking to park their capital?
That's a great point.
As a company, you are no longer just selling gold to customers. You're selling return on investment to franchisees.
That completely flips the script. You transform from a retailer into a financial platform that just happens to distribute jewelry.
Exactly.
We started this conversation talking about a traditional business being like a heavy cargo ship. wheeled down by literal gold. And what we've discovered is a company that figured out how to make someone else carry the anchor while they steer the ship.
That's a perfect way to summarize it.
Thank you for joining us on this deep dive. Keep exploring the layers behind the businesses you see every day, because the real story is almost never on the price tag. It's in the mechanics.